Hi everyone, my name is Vaughn and welcome to my channel called Kinto Flows. This is my first video that is being uploaded on YouTube, so I may not be as crisp and clear and as as sure of myself in making this video right now. But the reason for me creating this channel is so that I have seen a lot of wild stories of prices moving up and down every single week as a day trader. And I started this channel to share real, no fluff insights and stuff that actually helps you understand why things move and not just that they do. So if you're into day trading, investing, or just staying ahead of what's going on in the markets and news, I'll be here to try and cut through the noise that you would see. I think in this day and age of TikTok's Instagram Reels, YouTube Shorts that we consume on a daily basis, I feel that we consume a lot of hype media, especially if your algorithm is hit on the financial side of things, and a lot of it will tell you. So I've seen some reels saying like, oh, you should buy gold when it was at 4,300. You should sell gold, it's going to drop at any time. Sure, people can say and do whatever they want, but at the end of the day, the markets are following certain criterias, and especially when it comes to the pairs that I trade, like gold and Nasdaq, which is an index fund. It follows certain principles. Yes, I think in the current U.S. market and in the Trump administration, things don't follow along as they used to. I think some criteria have changed, and I think just giving some insight into that, I can at least give my knowledge as to how I was still profitable during the noise that was occurring, right? And yeah, let's jump into today's big one, which is gold USD or XAU USD. And just a little bit on that, I did read Reuters, and on Reuters there was some information on gold easing or gold trying to go down to a certain point. I think it's good to understand how large this bull run has been. I mean, from around let's say August, there was a massive push after a few months of the market ranging. So if I have to go here, let me pull this chart here. Let me go to a daily chart. And right here you can see, if I just zoom in a bit. So this range over here, this range right here, is where you can see it happened for quite a long time. So even we don't need to get the precise dates, but from around from around April, right? The market did range quite a bit. The market ranged a lot. And when a market ranges for a very long time, it usually means once there is a breakout, it's going to explode. It is going to push. So the way that it did push, it was more likely to go bullish than it was to go bearish. If you look at the US market at the moment, there is a lot of news. There was a lot of noise about the US dollar that's going to tank, this and that. But at the end of the day, they were trying to find out which way they were going to go. Now, who is they and who are these people that we are talking about? It is usually governments. You have to take the Federal Reserve, the large banks in America, as well as central banking as a whole. Central banking as a whole is usually follow policies and regulations across borders. And there are different stock exchanges that are around the world, but the main three are still based off central banking principles, and most banks follow the same set of procedures, the same rules, because they were set. If you go back in history, they were set by a certain family and whatnot. But we're not going to go into all of those details. But understanding that the central bank do follow the same systems or similar systems. From a framework perspective, they wanted to know whether we should buy more gold, or are we going to entrust US Treasury bonds, or are we going to trust the US dollar and economy in general? So that plays a big role in how the market will move. And the market has decided that the gold standard may be better than following the US dollar. You can look at different aspects of the market. But as a whole, yes, the US economy has become quite volatile. I think there are pros and cons in how it is being dealt with. But overall, I think there is a consensus that there needs to be some sort of commodities that back the US dollar. And I think the US dollar has long been a form of commodity. And now they are reversing that because of the $1 trillion that they have been sitting in debt with. There is an understanding that gold plays a larger role over a long-term period, rather than when they changed from in 1970. I think it was Eisenhower. He moved the US dollar away from the gold standard. So, look, gold has, what I'm explaining is this range was more along the lines of, do we trust the US dollar to be our standard of reference, or are we going to use gold as our standard of reference? I think it's safe to say, after this long bull run that we've had, right, from here we can say it pushed about from this point here at around 3415.45 on the 2nd of September. You can look at it, but it looks like it was ranging. It needed to push, and it did. All the way from September to 21st of October, it went all the way up, and then it finally decided to crash. The news will say, oh my god, it's dropped 6.3%, or however many percent it has dropped, but it is minuscule to the point of how far it has actually gone up, right? So just looking at it, what goes up must come down. It doesn't have to fall all the way to the ground, right? But yeah, this is the market that we are currently looking at the moment. So I want to just go into a technical analysis now that I've given my half-assed explanation of, or very terrible explanation of the fundamentals behind it. I didn't go into too much detail, but I think it's important to just get my perspective on where we are with gold and the US dollar. So from a daily perspective, we can see the market has really pushed, right? The market has really pushed, but let's go on to the 4-hour so that we are able to get a better trend line going, of just to show you that the market is technically still bullish, right? The market is technically still bullish. So let's do this. Let's draw a trend line from here, and the next point is that when it dipped last, and I'm just going to try and stretch this out as much as possible. So you can see I use this point here. I'm just going to do this, clean it up. Okay. So what you can see is why I used this point here. This was a 4-hour bullish push, and that's that push that showed a change of character on a 4-hour BOS, break of structure, and it continued to go up, right? 4-hour candle, so it did teeter a bit, but that was the initial impulse that was triggered when the central bank started buying more gold. So this is the point, the pivot point, or the swing low that occurred before this bullish run. So this is the bullish run, and as you can see, it's following this trend line. I mean, from this point here, which was the last dip before another massive impulse. So all I'm doing is following the last dip before another massive impulse, right? So sometimes it's a bit difficult to look at where to draw it and whatnot. It's easier in hindsight to look back and say, oh, we drew it like this. But this is just for reference to show you that the market is technically still bullish. However, yes, the market has broken structure for the first time. So the market has now broken structure, and you can see it right over here. I'm using an indicator, I'm cheating, I'm sorry. But as you can see, the market has broken its structure. And it's created a change of character. Now the change of character is still deciding whether it's going to push lower or it's going to go back to its point of going to all-time highs. So because of this change of character that occurred, a lot of the market sayers are going to say, oh, gold is reversing. There is no confirmation of that as yet. We are still technically on a bullish run overall, unless we see a close below this level here. I'm trying to get the most accurate number, but below this level here, I'll just draw a line here of around, let's just get it at around 4040 level. If we see like an hourly candle close below, or even better, a 4-hour close below this level, we know that we are in a bearish run, right? Right now the market is still deciding whether it's going to adhere to this change of character, whether it's going to adhere to this bearish signal. But at this point in time, it is technically just ranging. And how do we know that? How do we know it's ranging at the moment? Here we can see this. So we saw this impulse, we saw it came down, it ranged a bit, and then it went back up and it tested this high over here. It tested this high, it went above it, but it spiked all the way down and caused a crash, if you will. So since it's sitting in this position, understanding that the US government is still closed, understanding that we still have some issues with war going around, gold could range for a while. It could go up a bit, it could range along this market until we actually make a break of this trend line with an hour, a 4-hour candle. I would like to use a 4-hour candle for if you're going long term. But in this case, gold is still technically bullish. But because we are going to go down to the technicals, I do use SMC, smart money concepts, for gauging my day trades. I do scalp, but I also do long term. So if we are looking at the market here, right, there is a fair value gap over here, and a fair value gap is usually, as it's explained by actual traders on it. It's a gap in the market, fair value gap, FVG, right? So let me make this white so that it can be more clear. So I will type, this is a fair value gap, right? So it's basically a large impulse in the market between three candles, right? You can only create this gap between three candles. It doesn't matter how big the candle is. Okay, it matters how big the imbalance is of this impulse. However, you can see here, we can also draw another one here, right? So these are 4-hour fair value gaps, right? So these are points of interest. These are points of interest that the market can come towards to tap and then possibly go down. As you can see, I put it in red as the red candle because they are bearish fair value gaps. And how I understand fair value gaps is that the market moves too fast for the rest of the traders to catch on to, right? It's not about catching the trade, but by that I mean it's got to do with supply chain, right? The best way I understand it and how I explain it to those that ask me is that if you are you have a coffee shop and you sell a cup of coffee for $5 per cup, right? Now, a $5 cup of coffee is because of a few things. You have put margin on it. It may have a cost price of, I don't know anything about coffee shops, but let's just say the total cost of the actual coffee is $1. Then you still need to account for milk. You need to account for the service workers working in your coffee shop and all the other expenses that go along that contributes to the cost of you selling that cup of coffee, right? So we are not worried about the actual expenses of your business, but more along the lines of what coffee costs, right? So if you buy, and let's just say a bag of coffee grounds costs you $100 per bag, whatever expensive coffee that is. You still need to account for the fact that from an agricultural perspective, the suppliers of coffee, where you get your coffee from, like a wholesaler, they have it at a specific price that they have bought for a specific price from farmers, right? So when there is an issue, and let's just say coffee is there is an infestation or there is a storm, and all of a sudden the place where the farms where coffee is grown has now been depleted, ravaged, whatever the case may be. There is a shortage of coffee, right? At the end of the day, markets are about simple economics, and it's about supply and demand. So coffee has now is a commodity that everybody wants, but there is a small supply of coffee. The same applies to gold, depending on the supply and demand. Now, because of that, the price must go up or the price must go down. If there is a shortage of coffee because of some incident, it is going to go up in price because everybody wants it, but I only have a certain amount that I can sell, right? The opposite of that is everybody, it's the let's say, I don't know when coffee is best to be sold, but let's say in summer is when all coffee around the world is ready. For argument's sake, it's all ready, therefore coffee prices will go down, prices of coffee will go down. And now why it's impactful in a market scenario. The same thing goes with gold. As we see a need for gold, when the market sees a need for gold, there will be a price differentiation, right? The more reliant we are on gold, the more people want to buy it, but there is a certain limit or amount of gold that is available to the market that can only be sold at an X amount of price. And therefore, if there is a need for gold, especially because the supply does not increase randomly, you cannot grow gold, it's more likely to go up over time. Right? Yes, gold can be a bit complicated with its dynamic, because it's more like a currency that is backed off the US dollar. You can only buy certain commodities with the US dollar. However, the point is, you saw a big drop in gold. Was that due to more trust in the market? Was it due to sell-off? There's a few things that can be going on in the market. However, it is usually got to do with the fact that the market was so bullish for such a long time that there needed to be a sell-off at a certain point. Going back to my coffee example, if you are selling your coffee for about, again, $5 a cup, and there is a shortage, then the price that you are getting your coffee for is going to go up. However, there are things like supply that is already on hand during the process. Your wholesaler that you buy your coffee from already may have stock of certain coffee that you buy, right? And also the farmlands that are selling to the wholesalers will also have a certain surplus of coffee on hand. Therefore, the price of it cannot only be the same amount. If I locked in a contract with you to buy for excess amount, then the price will be as is until there is a shortage, until we have to renegotiate, because now you are going to say, I want to sell it to America rather than the UK, or rather than to China or Japan. But Japan decided to say, oh, well, we'll pay you more for your coffee. And that's where the hassle, the struggle for price range comes in. Who's willing to pay this amount for the coffee? And the same thing goes with gold. I hope this kind of makes sense. I'll try to do visuals in the future. But at the end of the day, you need to come to an average price range, and that's where a fair value gap will come in, and why the market usually retraces back to a fair value gap. So a fair value gap is an impulse where the price moved too fast due to some media, due to some economic data releases. But quite often, in a bullish run, it is temporary. Even if it is on a bearish run, it is temporary. So this shows a place where the market can go back to. Now, there's no absolutes in trading, but the market can go back to this as a reference point to say, okay, gold is now sitting at 4,112. However, there's still some stock that was purchased at around 4,000, let's say between 4,190 and 2,000 and 4,240. So this is your range of prices that are still being sold in a retail perspective. So because it's being sold in a retail perspective, there are people buying gold in this price range, but this is not everybody. right? Unless there is more data to assert the fact that gold should go down further. Like the US government opening up again and saying, we are going back to the gold standard. My God, gold will skyrocket again. So there are things like that that comes into play where the market needs to retrace back to these points. So one avenue of trading on a longer term perspective is looking at the market coming here and then floating around here and then showing a change of character and then actually coming down, right, more along to this area here, right? This would be one scenario. Another scenario would be the market goes all the way here, similarly comes there, and then it goes down, right? So those are two bearish scenarios that can be looked for on a 4-hour time frame, right? Which is where the market will likely come to, unless there is some economic data or market news that pushes it further down until it has to come back up again, right? This can be seen if you backtrack on your charts. I mean, if I have to go back on the charts, I mean, this can be seen a while back. If I remember correctly, it happened very similar market. Yeah, here. Very similar market, but it pushed down for a bit. It reached a certain point and then it started to come up. I think it's here. Kind of a similar range that is occurring around here. And then it pushed down for a bit, and then the market continued to range for a while until it decided to move up. All right. So these are two scenarios that are more likely for bears to step in, because a change of character is on a daily and a 4-hour, right? But the 4-hour is not as sure. It does not give much surety, and this is why I say it is technically in a range, because there was a massive dip down, and this is the lowest point that has reached, and this point right here has not been tested as yet. So there is liquidity sitting below this line. A lot of liquidity sitting here. So this is also a point where the market can. So another scenario that is that the market, right, depending on the news, to come here, and then it will teeter for a bit, and then it starts to go up again. Let me put it here. Right. So those are three scenarios that could occur that I foresee in the next week on a long-term perspective. I don't want to go into scalps because honestly, nobody knows where the market is going to go at this point in time. You could go for buys right now and you could be right. You could go for sells right now and you could be right. The probabilities of where the market needs to go, it needs to tap certain points in the market, and for that to happen, there's certain points in the market that need to be hit. And another point is why I'm pushing it there, but it didn't actually touch that point. It was close enough, but it's around here, the 3900 zone. So actually I wanted it to touch this, and we'll make this green because it's bullish. So this is my scenarios that I would like to see play out. If you were to go on a bearish streak, I'd want this trend line to be broken again on an hour or a 4 hour, or I would want the market to go to these zones. So you will see, and there are many videos around where you can see how to trade against a fair value gap. What is a change of character? What is a break of structure? Those things, if we continue on, we will be able to explain those zones. But this is my scenarios for the trades of the week. I will get better with these videos as we go along. I apologize if it's long or if anybody sees this. But yes, thank you very much for your time, and take care.